All right, everyone, thank you for joining. Topic for discussion for this webinar is real estate and the state of real estate. So I'm really excited to have this discussion because your primary residence and real estate is, for most Americans, one of their largest assets. So I'm happy to have this discussion today with Tom Bickett. Tom, if you could just introduce yourself and give us a little bit of your background and how you're working with your clients on a day-to-day before we kick this discussion off.
Absolutely. Rory, thanks for having me today. It's a pleasure. My name is Tom Bickett. I represent a company called Annie Mac Home Mortgage. We're headquartered right in Mount Laurel, New Jersey. I have my office in Gloucester County. I'm approaching my 20 years here in April, tax day actually, of being a mortgage lender in the local market. I cut my teeth working for a money management firm, Lord have it, way back in the day out of college. I got my business degree from Cornell University. And I realized that over the years, I truly love helping people manage one of their biggest assets through mortgages. Debt management of an asset is equally as important in how you manage what you do, the holistic approach to overall financial well-being and wealth. So, what we do is a simple part of the overall picture, but, for many people, whether they're a first-time home buyer, an upgrade, a downgrade, investment, second home, it's a large purchase. And it's more than just, hey, congratulations, here's your pre-qual letter, which a lot of people out there will do, but it's really designed about how does this fit into a bigger picture with cash flow, asset management, and ultimately buying a home that can hopefully generate some long-term wealth, as well as how's your family.
Yes, awesome. So let's start kind of somewhat what's happened recently, maybe last 12 months, and then let's zoom out and really look at the real estate market, home sales, and what's really happened to prices. So I'm going to use a chart that we kind of speak to and provide some context to follow along a little bit better. But that's what I really want to start is, what have you seen? What's happened in the real estate market here in the U.S. over the last 12 months or so? And then have there been any present themes that we've been kind of living through over the last 5 or even 10 years?
Yeah, absolutely. So, I think every person out there, whether they're a homeowner thinking about home owning or renting, wherever it is, obviously the big conversation is interest rates. We came out of a period with COVID where we were already in a low interest rate environment for the majority, post financial crisis. We saw interest rates get incredibly low. We had a lot of intervention from Fed and Treasury to help, create a low interest rate environment to keep things moving, right? And COVID took us down to levels that, if I could get in a time machine, I'd go back there in a second, where we saw interest rates, in the 2% range. Even we had some people get 15 years under 2%, started with a 1, which is incredible. Yeah. But then inflation.
Let me even help you out with that visual here. So so this is a 5-year. I'll just set the context and then you can run with it, Tom. So what we have is a 5-year chart, and in orange we have the 30-year mortgage rate. So to Tom's point, dating back to early 2020, we saw that decrease in rates. Then Tom will take us through what's happened. And then in blue here, or purple, you have U.S. existing home median sales price. So this would be the overall return or overall growth, if you will, of existing home sales. So up 41% over the last 5 years. And then you can see, which Tom, I think would be great for you to kind of walk us through interest rates over the last 5 years. But just to kind of set context for you and also everyone tuning in, this chart is given a little bit of validation of what you were describing in terms of
Absolutely.
COVID dropping rates.
Yeah, so we saw that super low environment, which, if you already owned a home, chances are you took advantage of a refinance and locked up incredibly low rates, which is fantastic. But, shortly thereafter, we started to have some problems with inflation. Inflation neared 10%. And, the Federal Reserve, as part of their mandate, is to help control pricing in the open market. The definition of inflation is too many dollars chasing too few goods and services. So we had supply chain disruption. We had inflation get near 10%, and the price of everything went through the roof. So they started in early 2022 to start to raise their policy rate with a goal of bringing inflation down to a 2% mandate and to help limit the amount of job openings in the market. And why is that important? Is, if there's fewer job openings, people can't just job hop to get more money. They have to stay in the companies that they're at, right? So that helps bring down inflation. And we're getting close. Inflation's kind of hovering around 3%. It's getting a little bit of stubbornness. But over the last 3 years, because of them increasing their federal funds rate, that trickled trickled into the mortgage-backed security market, the MBS, and that's where we get our mortgage pricing from. So we've seen that escalate all the way up, and the spike on your little yellow chart there occurred in October of 2023, where we saw mortgage rates near 8%, which is over a 30-year high for what consumers are expecting. So we went through this really weird transition of super low rates, historically low, to 30-year highs. And you would think that would have derailed the real estate market.
100% is a double, right? Over 100% is an actual double of the 30-year mortgage rate, which that's tough to swallow if you're out there searching. Yeah.
So you would think with that rapid rise in interest rate that we would have seen home values, peak and or maybe even take a back seat with less people deciding to get into the home market. But the reality is we're still seeing really good price appreciation in real estate in spite of that. In this chart, I think if you went out, I think we looked at a 10-year chart, which I think is a little bit better example of what real estate assets have done over a longer period of time. So that blue line is the appreciation rate of median home prices in the U.S. And I think here in New Jersey locally, it's actually been a little bit stronger than that. But in spite of interest rate volatility, we have still seen really good price appreciation in our country. And what that tells us is that we have a little bit of a supply and demand challenge in our market, right? In most markets, we have an abundance of demand, and we're going to touch on that here in just a second, and we have limited inventory. For those of you that have been around back during the 2000s, where we kind of went into a financial crisis that came off the heels of a crazy real estate market, we had tremendous amount of inventory, some of the highest inventory levels we've ever seen. They were building houses in every piece of land you could see, developments left and right going up, and they over inventoried the marketplace. And new home construction, look around, you're not seeing a ton of it. There has spot builds here and there, maybe townhomes, but reality is they're not building enough inventory. So our markets are relying upon resale. And you have an incredibly populated market right now. I'm going to do a quick screen share, Rory, that gets into something that I've been studying for the last couple of years. What this chart here is a reflection of birth rates in our country, right? So we're talking about age population, we're talking about demographics. This chart goes back to the Great Depression, 1929, and it breaks that down. We have 5 major generational groups over the last 100 years, right? You have the silent total, you have the baby boomers, my generation, the Gen Xers, millennial, and then post-millennial. I think they're calling that the Gen Z, right? And if you go back in time, when my generation really was starting to show up to buy homes, average age of first-time home buyers for my generation was around age 33, right? So we were showing up in that 2002, 3, 4, 5, 6 timeframe to purchase our home. And I remember shopping for a house. I looked at 30 houses, and I could have made an offer on every single one of them because there was really good inventory back then. Okay. So there was so much inventory. And
were your offers, were you going below asking price on those offers just because the supply was there?
Yeah. Now, the house that we ended up buying, which I'm still on today, we got a little bit of a bidding war, but it was just one other person. And I think we went like $5,000 over list and we got the house. Right. And that asset category, unfortunately, just, fell overnight because of the amount of inventory that was in the system and the lack of buyer demand that truly was in that system. Now you roll the clock forward, they say that the average age of a first-time home buyer is 38 years old now. People are waiting longer to start family formations. And that's evidenced by the fact that this chart right here is the midpoint of when the millennial age group really started to take off, right? So if we go back to someone that was born 38 years ago, you're talking about 1987, 1988, which is right in the midpoint here. And if you see here, the growth rate in population during the late 80s and early 90s remained incredibly elevated, so much more than what we experienced in our generation. Not quite what the baby boomers were, but a ton of people. But it remained elevated for a really long time. And that bled into the next generation of the Gen Zers. So if you were to draw a line across here, all the way across, we have been so much elevated. There's so many people out there that need to buy a home, and home participation in that age bracket is still relatively low, right? So when you think about demand in most marketplaces, there is a backlog of demand. Some of those people are priced out of the market, right, because of interest rates or because of price or a combination of both. But as the market shifts and interest rates eventually come down, there is a backlog of people that are ready to participate in this market. And that's really what's driving a large portion. I'm going to take just one quick county look. I'll take up near you, Burlington County.
Yeah. And while you're switching there, Tom, I just want to remind everyone, so if you have questions, we will take them as we go. So feel free to use the chat feature or even the Q&A feature. I'll try to look at that. And if you have questions as we have this discussion, put them in the chat. I'll be happy to kind of frame those, either have Tom answer them or myself as we go through this. But yeah, Tom, walk us through what are we looking at here?
A quick local market update snapshot, year over year from February of this past, we just passed to February of last year. And one of the things a couple of key things that I look at, right? Number one is days on market. So new homes are not lasting. Someone lists their home, it's taking on average 27 days to get that under contract. Now, a year ago, that was 18. And I think this year had some seasonality too. We had a little bit colder winter. Everyone was focused in on the Eagles probably winning the Super Bowl here, at least in Philadelphia. So they're out necessarily buying homes, but there's some seasonality here. So we saw a little bit of increase there. But the thing that really tells me the state of real estate is deals that went under contract at list price or over list price. So nearly 57% of transactions in February went to the closing table at or above what that home was listed for. And last year, a little bit higher, okay? But the reality is that the majority of deals are still happening with people paying over that list price. Almost every single client I have, and it doesn't matter if they're a first-time home buyer, someone who's upgrading, someone who's downgrading, looking for an investment property, buying almost every single segment of our marketplace, it is a bidding war out there. So people are still willing to for lack of a better term, overpay versus what that listing agent might be listing that home for. Now, maybe there's some strategy there to list low and get a bidding war going, but people are still willing to overpay in spite of what's going on with these interest rates. And if you take a quick peek at this graph down here, and I think this is a pretty good reflection of markets. So purple is at ask, above ask is green,
wow.
And this pink section is below ask. So if you go back to pre-COVID, almost everybody was able to put a deal together.
Is this Burlington County still?
This is still the Burlington County.
Reign true for national?
Yeah. It's okay. You might have some pot. Florida might be a little bit different. California could be a little bit different. Texas could be a little bit different. But as a widespread analysis, I think what we have going on here in New Jersey and the Philadelphia suburb is a pretty good representation of what is going on in the wider United States, right? Okay. And there's some areas where the tract builders have gone, like Texas has been booming, and they're starting to see some price reductions there. California, there's some things going on there. We're seeing some price reduction. Florida, you're starting to, everyone flocked down there during COVID because of working home. Like, why not go to Florida? Starting to see a little bit of that down there. But in the local market, almost 60% of deals were going to the table pre-COVID where they were paying under list price. And you see how quickly that changed. Leading out of COVID, we've basically been stuck at the same rate. The majority of deals, the purple and green, are taking place with people going in at above list. And Burlington County, the last 12 months.
And at a time when it's become more expensive to finance a property.
Yeah. In spite of interest rates and pricing, people are still going at or above. And let's just look at the last 12 months. In spite of high interest rates, Burlington County, average median price up 5.6%. This is Camden County. That's up 13.3% in the last 12 months. Gloucester County up 11.9% in the last 12 months. So again, in spite of interest rates, we're still seeing really good price appreciation across the board.
What's driving that? Do you think it's primarily just the lack of supply and the abundance of demand out there?
Yeah, take Gloucester County as an example. Right now in Gloucester County through February, now this is all of Gloucester County, there were 569 active sales and 336 pending sales. Like, that's not a lot. You go back pre-COVID, a balanced market, supply used to be closer to 1,500 to 2,000 homes availability. So we're nearly a third of what inventory was in a somewhat normalized market. And what's driving that is simply the function of you have a lot of people in their homes at a really low interest rate. So unless there's an incredibly compelling reason to sell, why would I give up my 3% to go buy a house at 7%? So I think the biggest movers inside of the marketplace really are those people that have major need, right? What we're seeing now, I kind of break into three very specific categories for residential real estate. Is you have first-time home buyers, right? That's always going to be a market for people that when you compare to rent payment versus home ownership payment, the numbers clearly make sense to be a homeowner long term.
Even with higher interest rates.
Yeah, because rental rates are at all-time high as well. Right. So yeah, you might be stuck paying a little bit higher of a monthly payment than what you were comfortable paying, but it's still better than renting and not building any equity. And when you're
especially
looking
if
at
that house is appreciating like we've seen over the last 5 to 10 years. Yeah.
I mean, if you take Camden County with the average median price going up, 11%, if you jumped into the market with limited down payment, first-time home buyer, high interest rate at, 300,000, that home today is worth somewhere between 325 and 340,000, right? Incredible asset gains, which leads me to my next segment is what I call the first-time home seller, right? There's a lot of first-time home buyers who did jump in, took advantage of down payment assistance programs. They bought their home, with very little money down 4 to 5 years ago. I'm talking to clients now that are, 28, 29, 30, 31 years old. They got married, they're having some children, and they need a bigger home, want a different school district. They have 6 digits of equity in their home. Had I asked them 5 years ago, hey, I know you're only putting down $10,000.
Yeah.
Could you imagine having over $100,000 of equity in 4 or 5 years? And what's allowing them to make that transition is they can make a large down payment on that next house because of all that equity. So they're rolling that equity forward into a bigger, better asset category. And everyone in our industry says, you date the rate and you marry the house, right? You find the home that works for your budget that you can afford. And yes, at some point in the future, hopefully sooner than later, we're going to see interest rates calm down. That's what happens, right? Things are cyclical.
I like that. Yeah. Date the rate, marry the house.
Yeah. Because if someone's going to say, I'm going to wait for interest rates to drop, right? I'm going to wait for my interest rate to get to 5.5.
Yeah.
Well, everybody else is. And what is going to continue to happen to that asset category? Yeah, you might get it at a better interest rate, but you're going to be paying a big premium. Let's say it takes 2 years to get there, and we stick at these, 6 to 10% appreciation rates. A home that you could buy today for 300, that might be worth 360 to 390 in 2 to 3 years.
I have a really to jump in here because it's somewhat related. It's a little bit of a different case study here. I have a really good question from the chat. So it's what is the recommendation for retired people who are looking to downsize? However, their existing interest rate is between 2.5% and 3%. It doesn't feel like a good financial move to sell with interest rates and the quality of available homes in the market. Comments on that?
Yeah. So first of all, it always boils down to the why, right? Well, why would you be making this transition? I'll speak from, so this leads into my third point. I said there's 3 categories that we're seeing. The third largest category of people that we're seeing are those downsizers. People who raise their kids. They had the 4 or 5 bedroom home. The kids have now migrated out on their own, and you're left with this home. Maybe it's a 2-story. Maybe you're thinking about the future. The stairs are getting more intimidating every day, and you want to simplify your life, right? For many of the clients that I'm running into there, they have a ton of equity to the point where, okay, you might have a low interest rate at 2.5 or 3.5%, but how much money are you really going to borrow to get into that next home? Because chances are you're going to make an incredibly large down payment, or they're going to make a low down payment and maybe give the residual to you, Rory, to invest into their future. But I think you really have to look at the numbers. Number one, why are you making that transition now? And what is that picture going to look like if we wait a year, 2 years, 3 years, 5 years? Listen, I don't think we're going to get back to 2.5%, 3% interest rates unless we go into something like a pandemic yet again. And even if we do, I believe our country, learned from their playbook that they ran last time. I realized they kept interest rates too low, too long. And that created so many other problems that are playing out still today. So I'd really be surprised if we were to get back down to those levels. most pundits out there, you read the tea leaves with, the people at Fannie Mae, Freddie Mac, people who have a business trying to prognosticate things. Most people think that the long-term 30-year fixed interest rate is probably going to land somewhere in the mid fives, maybe low fives if we're lucky. It's going to be tough to get into the fours. So we're really not that far off now. Number one, but number two, it gets back to why are we doing it now, and can we structure a deal that makes sense for you financially from a monthly payment perspective?
Yeah, I really like your point, Don. You got to look at the numbers. That would have been my answer as well, because yes, if you are going to sell the primary home and take those proceeds to downsize, and you're not able to just purchase the property outright, there's going to be an element of debt there. There's going to be some sort of mortgage. But what else is there? If it is a smaller home, you might be looking at less property taxes. You could be looking at less utilities. So what are all the factors at play? For us, what we would do is we would probably take that to the financial plan, create a what if scenario. What if we downsized? Well, let's go a little bit deeper into that and get an understanding. And yes, we might be having a higher interest payment or a higher interest rate, but maybe the monthly payment stays the same, or maybe the payment might come down. So there's more factors at play. Plus, it's also like, what do you want to do? Right? How many more years do you have left? And do you want to be slaving over this large house? Or are you going to be more comfortable? Is the area and the location going to be more beneficial? So there's a lot there, but it's really a great question, and it's one that sounds like you're kind of dealing with.
Yeah, comfort is not something you put an interest rate on, right? Quality of life is not something you put an interest rate on. When you send in a payment to your bank, you're not putting an interest rate on it, right? So life for me is about cash flow, which I know is the same for you, Rory. If we can make sure we're putting you in a good cash flow position to live the life that works best for you, then that's probably a win, in my opinion, right? My in-laws just did this themselves. They're 68 years old. They sold their forever home of 40 years. They were free and clear on it, and they bought in a 55 and over community in a very competitive market where they don't come up very often. So they were able to go in and make a really competitive offer. Use some strategies that we had, and ended up being able to buy that home cash. But he was prepared to take a $50,000 to $75,000 mortgage. And the other thing too is, interest rates become incredibly less sensitive to the amount of money that you're borrowing. Right? There's a big difference between borrowing a $100,000 mortgage versus borrowing $1 million mortgage. Interest rate sensitivity is very, very sensitive to the amount of money that's being borrowed. So again, it's situational. It's case by case, but it's definitely something that you just got to understand your numbers and understand your comfort level.
Yeah. Another great question. What needs to happen to incentivize builders to add to inventory?
I think that builders are still stung from 15 years ago. And I feel like you're not seeing these huge at least here locally, okay? The big national builders will go into areas where they're seeing just more population growth. I'm not a political guy, so I'm not going to comment politically, but my guess is you probably need to reduce some of the friction for new home builds to be able to go into marketplaces and build quickly. I think number one, so reducing regulation, not code, right? We still want it to be built properly, but just a lot of red tape there. And I would think that if they can offer the builder some incentives from a tax advantage corporation to say, hey, listen, we're going to help you out. We need more homes. But I think, and builders have been coming back online, but they're just so far behind the eight ball from going offline that it takes time to ramp. I think they're also concerned with what may or may not happen with tariffs, right? A lot of goods and services
go there. Yeah.
Yeah. A lot of goods and services are coming in, and they're just afraid because they just don't know. I've talked to a lot of different people in a lot of different markets. I was having lunch over the weekend with somebody who's a C-level at a snack food company. And while most of their ingredients are locally sourced, tariffs are something that they're thinking about. I was talking to somebody that owns a titling company for automotive, and they're nationwide, and they're concerned about how tariffs are going to impact auto sales and used car sales. And, so tariffs are something that we don't know its impact on inflation. We don't know its impact on supply chain, but it's definitely a concern of people that need to manufacture things. So I think clarity will probably lead the way to builders. So if we see interest rates coming down, we get some clarity on tariffs, supply chain, it will pave the way for builders to continue to build inventory in needed areas. Yeah.
Let's go to something that, I'm sure both of us receive and tackle from our clients here, which is, how much do I put down? Okay. Interest rates are higher. So should I make a larger down payment when I'm purchasing a home, broadly speaking, or what should they be thinking about when they evaluate what is that down payment? Your in-laws decided to not finance anything and purchase that cash. And there's some tremendous benefits to that for peace of mind, not having that mortgage payment, eliminating interest rates. What if you're not able to do that? You're a first-time home buyer, or you're selling your home and you're upgrading. What should people be thinking about in terms of how much they put down and how interest rates might play a role or factor there? Because I think you and I can kind of go back and forth on similar views here.
Yeah, it's probably the number
And I'm using
one
this
question.
as context just because I will overlay the stock market for perspective, but what's the thoughts there? What counsel do you provide?
Yeah, it's probably the number one question I get for people is how much money should I put down? Or I was told I should put down 20%, right? So there's some myths that exist in the marketplace. Again, for me, it's always going to start with the payment conversation, the monthly payment that you're going to be making on this investment, and is it comfortable for you? Some people, while they could qualify to put, let's say 5% down, that payment is going to be way outside their comfort zone.
Right.
So for them, right, there's a comfort conversation that's going to take place. But once
what
we
percent
understand
of their income is going to be the mortgage payment?
Yeah. So once we understand comfort, right, that will lead us to price and taxes. So now we're shopping in an area that's going to allow you to have a payment that fits within your comfort zone. Because I always tell people, banks and lenders like myself are going to be willing to give you a lot more money than you're actually comfortable repaying. Right? I had someone in the other day, they wanted a payment at $2,500. They could have afforded $5,000. And I'm like, if I showed you what that looked like on paper, you would choke. But reality is that it starts with payment, right? And in the belief of I have to put 20% down, PMI, private mortgage insurance, is something that is incredibly affordable, and it offers the people the luxury of not having to put down 20%. And why is that? Every $10,000 you put down in a home is only going to save you about $60 to $65 a month, right? It's not massive savings. And when you look at the power, I think Benjamin Franklin said it, right? The greatest invention we ever had is compounding interest.
Yeah,
right. So when you could take an asset and put it into another vehicle that can give you long-term potential growth compounding, I would definitely encourage people to evaluate the opportunity cost of that dollar, right? Yeah. I can either take that dollar and put it into a hard asset like my home, which requires me to either take a second loan to get it out or refinance my loan or sell my property. So once you put that asset in, you either have to borrow it back or sell your property. Sure. If you don't put it in and you still have a payment that's comfortable, so let's say you do whatever it is, 20% versus 10%, and now you have that money still liquid, and you can hand that money over to someone like you to, again, put into the long-term financial plan. I think there's a lot of value in that. Yeah. So it starts with payment first and understanding that comfort. And once we understand that comfort, that's going to lead us to the proper down payment and utilization of money.
Yeah. And I get the question, or even I'll see sometimes prospective clients that have a very low interest rate, say it's 3.5%, and they have a lot of expenses. They might have children, they're still working, they haven't figured out retirement yet, and they're putting more money into is that you? Okay. Yeah. and they're actually putting additional funds to try to pay the home off sooner. And I just say, hey, listen, let's evaluate that. And what I have here is, well, what could that money be doing? Because if you're you're putting more money onto that house to pay it off sooner, that's great. That's a great goal. That provides peace of mind, lowers stress potentially. But what are you receiving in terms of that rate of return that you could otherwise have if you invested those funds? If you're putting money into a mortgage that's at 3.5%, I almost equate it to, it's like you're buying a 3.5% CD. Well, right now, I can get you a high interest money market yielding over 4%. So could that money be utilized? The other thing I'm not a big proponent of is you're tying up the liquidity. Once you put the money into the home, how do you extract that? You need to sell the property, or you need to take a line of credit. And you know better than I do, what are the interest rates on home equity lines of credit right now? Yeah,
I mean, you're mid sevens and upward. I quoted someone the other day near 10% based on their profile. So it's definitely, it's better than going to credit cards or taking on a personal loan.
Sure.
But it's still, you're still paying interest on your money, right?
Whereas if clients had those assets invested, hopefully
Yes.
diversified, like how we do it for clients, you have an emergency fund, you're able to utilize those funds. But also, what's the opportunity cost? So what I'm now doing is I'm overlaying the S&P 500. And believe me, I am not saying invest in the S&P 500 in 100% of what you would have put on for additional payments into the house. But it's just giving some perspective that even though we've had a rocky start to this calendar year, over the last 10 years, money in the S&P 500 is up 223%. Given the 30-year mortgage rate has appreciated by 75%. Said differently, could you provide or could you generate a return above that 3.5% mortgage rate with those assets outside that could be liquid, that you could utilize? And right now, that's a pretty low hurdle to jump over. Now, that conversation might be different if someone's got a 7.5 or 8%, mortgage, depending upon where they are. And that's why the financial plan is going to be critical. But sometimes I see there's really no justification for doing it. And it's just, let's step back. Let's look and evaluate what are we making a decision to do and then why. Tom, I'm not sure if you have anything on this chart because I don't think we should really compare it, but I'll even note that the median home sales price increase of 88%, if we look at a yearly average, that's somewhere in that 6% range. I like how it's somewhat consistent, that you've seen just home prices continue to appreciate in value over the last 10 years.
Yeah, I mean, if we had that chart, expanded out, just like the S&P, almost every asset category given a long enough time frame where is going to most likely produce. It's when it's short-term volatility that can cause people a little bit of panic, like we saw in real estate back in the mid 2000s, right? But what caused that? We had bad mortgage lending practices, right? We were probably going into recession anyways, and we had unemployment jump upwards of 15%. Right now we're hovering at 4.1% on unemployment. The Fed is really focusing on this soft landing concept. And even if we did see unemployment, move up a little bit, 5-6%, I really don't think it's going to derail what we're seeing in the real estate assets simply by the sheer function of the supply and demand curve that exists. Until you get the demand out of the system, pricing in real estate is going to be supported to potentially continue to elevate, right? So it's a good asset category, but people don't buy residential homes to live in because of the appreciation rate, right? They buy it because they want to have a place to have a home. They want to have a place to have a family, and build that
Some flip
journey,
though.
build that story.
Some do flip. Now,
Some
this
do.
is kind of, and the reason I'm kind of bringing that up is another question that we're getting here is, what are the real estate investment opportunities or strategies in today's market? I certainly have some comments. I'm interested of what you're seeing out there. And the reason I bring in flipping is we were talking offline that I know you're seeing less of that now, likely because interest rates are higher. But where do you see opportunities? Where do you see some strategies?
Yeah, flipping is a market. I talk to a lot of flippers. I don't flip personally. The challenge of flipping is that, again, you have a high asset category, right? So it's harder to find the deal, and the costs of goods and services to renovate that property are higher, right? Labor costs are higher. So unless you can do all the work yourself, I can barely hammer a nail on a wall. So if I were to do that, I'd have to hire somebody, right? Labor costs are near an all-time high. Material goods are all near all-time high. So it's tough to find those deals. If you're in that market, there's definitely opportunities out there, right? And the distressed resale market that we saw 12 years ago, it isn't coming, right? COVID didn't lead to this massive foreclosure shadow inventory that existed. Yeah, do people still find themselves in tough distress situations? Sure. Some people are willing to take a cash offer just to get out of a house, or we're seeing maybe an estate sale where the kids just want to get out and they don't want to do any work, so they'll fire sale it. So there's still some opportunities out there to flip. I am a buy and hold strategist. I have investment properties for buy and hold. I like clipping coupons every month, so to speak, from my renters that can help build great cash flow and great appreciation. So I think if you want to be in the real estate investment game, there are still opportunities to do so. On flipping, you just have to know your numbers, right? And the expectation for profit probably has to be reeled in a little bit, but there's still opportunity to make money there. And there is still opportunity to buy and hold. Rental rates are still at an all-time high. Why? Again, it gets back to what we talked about previously, right? There's just too much demand for living space where people, if they can't afford to buy, they're going to look to rent. So
Sure.
rental rates are still consistently high. The things that drive down rental rates are the same things that will drive down asset prices, which is, recession and large unemployment numbers. Again, here locally, with where we're at, knock on wood, I don't see that playing out anytime soon. So if you're
Yeah.
thinking about adding cash flow through real estate, there's still great opportunities to do that. Multi-unit, we're seeing a lot of that. So it's still there. The short market's its own market. It's pretty consistent. You don't see a ton of price drops there. The challenge down the shore is inventory as well. Everyone who went down to buy a short house during COVID had these these short properties / Airbnb / semi-investment properties locked up at 2.5%, 3% interest rate. So that market's a little bit slower on the resale, but the asset values are continuing to hold because they're not building any new homes. So
yeah, I think you're dead on that. If this is an environment where the average age of a new home buyer is 38, and it was, to your point, 33 a number of years ago, what are they doing? They're renting. So I think the residential rental market is likely to be strong for the next several years. So if you're fortunate to own a property and rent it because of inflation, you've likely increased rent or you have the ability to do so. So now you're increasing the rent, but if you have a fixed 15-year or 30-year mortgage that you locked in at 3 or 4, you're getting a lot more of that spread, and you're keeping that spread. Other things that might be difficult to do individually, but I think there's a lot of opportunity in the industrial space and warehouses. The whole e-commerce movement is alive and well, with Amazon boxes showing up at everyone's doorstep on a almost daily basis. So they got to house that product. They got to house that. So that's industrial, that's warehouses. And I also think that the new one is the data center build out and the need for increased energy, increased data storage. We're seeing that, and we use some private real estate investments and trusts for clients where we'd rather be passive, let them do it, and then we'll receive that coupon, we'll receive that appreciation. Some of that performance has been slow over the last 2 years because of interest rates, but we might be on that cusp of seeing that asset class start to turn and become pretty lucrative for those that have kind of held on despite fairly flat returns the last couple of years. Great. We have about 15 more minutes here. I do want to get into some discussions where, is there anything new out there? Because I think most are used to the traditional 15-year mortgage, 30-year mortgage. I had a client reach out to me last Thursday, and it's looking to purchase another property. They have a current property. They're looking to purchase a new one, and might need it to be a contingent purchase because they need funds from house A to buy house B. So are you seeing more ARMs? Are you seeing still a lot of 15-year and 30 years? And what options do you have for that individual that frankly could lose out on that to a cash buyer, right? That just comes in and say, hey, easy. I'm not contingent. Here's your money. I'm going above ask, sign here. Are you seeing anything there? Is your firm providing solutions for that?
Yeah, it's a great question. Thanks for bringing that up. So on the product front, right, it's still predominantly 30-year fixed for most of our clients. We're starting to see a few people who bought in the higher elevated interest rates come in and do some refinances there, and they are taking out the 15 years. We're starting to see some 15 years creep into the high fives, which is nice. So
oh wow, okay.
So that's decent, right? That's moving in the right direction. So that's simply a rate and term play on a refinance. On the purchase side, I'm not seeing too many people take 15 years. The ARM product is still, you're not seeing great ARM pricing unless you are like a portfolio lender at a big bank. The secondary market, mortgage-backed security market's not loving the ARMs, and consumers aren't loving the ARMs. I think most people were stung pretty hard by ARM products back in, during the last financial crisis. So I think there's some stigma around ARM products.
They're kicking themselves because they could have locked in at 3.5 and they did a 5-year ARM at 3. And then they're like, ooh, when that resets, it's going to sting. Yeah.
So I think there's still some stigma from having an ARM product. There's just something about having a warm, cozy, fixed blanket that people feel good about. We identified some problems in the market at our company, in 2021, leading in 2022 with this inventory challenge, that good quality borrowers who can make great quality offers were missing out for two reasons. One, there was a lot of cash in the system back then. There's still some decent amount of cash in the market today, not nearly as much buying back then. But the contingency, right? If I'm coming to the market and it's a multiple bid situation, and my offer is like, hey, listen, I'll pay you. Hey, I'll go over list. I'll go $5,000 over list, but
Sure.
let me sell my house. Thank you next, right? There's
Right.
enough.
Where's the money going to come from for that
Yeah.
down payment, especially if you're upgrading significantly? Yeah.
Yeah. So sellers are unwilling to take on somebody else's contingency. And in this market, as long as we're elevated with limited inventory and high buyer demand, it's going to be incredibly difficult to get a contingent offer accepted. So what we did is we created a product that we call Cash to Keys, where we step in and we can allow that customer to be able to make their own cash offer backed by Annie Mac Private Equity. So if someone is home sale contingent and they're approved for our platform, we will go out to market and buy the new house for them, utilizing our cash, let them move into it and reside there. And as soon as they sell their home, we will simply resell the house to them for the same price we paid. So it allows you to participate in today's market leveraging cash without the concern of financing or having your home sold. And that's been a game changer for our clients.
Is there a minimum or maximum time frame on that, where certainly there's some risk on, okay, you're helping out and you're purchasing house B for the client contingent upon house A selling.
Yeah.
This is a good seller's market, but like, what if that's 3 months, 4 months? What if there's home renovation that is desired for that house B purchase?
Yeah. So it's not going to be, one size fits all, right? It's very custom in how we look at it, but we give them 6 months after we've purchased the new home to be able to buy the house back from Annie Mac Private Equity. And if you look at all the charts that I just shared with you previously about our local market, average days on market is ranging somewhere between 20 and 25. And just since we started the product 3.5 years ago, for my clients, on average, it's about 35 days from when we've bought until they're buying back from us. So unless, number one, the customer is unrealistic about price, or number two, the market dramatically shifts in a really quick period of time, which again, I don't foresee that playing out that way. And if we do see that playing out, I'm sure we would change the product mix. But our customers have not had a problem getting their home sold in a reasonable period of time. And in terms of the renovation, it just depends. Like my in-laws leverage this product. We call that product, they use Cash Bridge, the mortgage-free option of Cash to Keys. And we purchased the home. They went in there, they did some flooring, they did some painting, they did redid the garage, they did some closets, some minor stuff we would allow. We don't want full-blown renovations taking place while we actually own the property on their behalf. So case-by-case situation, but it's really helped our clients be able to make stress-free, more competitive cash-backed offers without the headaches of a contingency. So it's changing the game for our clients.
Wow.
And we can do that for first-time home buyers too. We can issue a cash guarantee. The other thing we did is we realized that if people are going above list price, if I'm a good agent, I say, hey, you know what? I listed the house at 400. I think that's where it's going to appraise. If you go above ask, are you going to guarantee the price? Right. So what we did is we launched something called Annie Mac Appraisal Waiver, where we can actually, for our clients, come up with a predetermined number for which we would allow them to go up to on the offer price and not have a value-backed appraisal done. So again, it removes the uncertainty in the marketplace to go make a confident offer that we all can stand behind, that reduces the risk to the seller. So again, it's really about being different. Like the days of just, hey, here's your mortgage, like tell me when to find a house, are gone. Like we have to better support our partners, our consumers, and be able to make strategic offers that actually have a chance of winning.
Yeah. So that's a good, interesting point there at the end is this being done to help you win the business? Obviously it could be helpful to the buyer in a tremendous fashion. Are they paying for that in the form of a slightly higher interest rate, which I would, argue probably would be worth it? Or is it really just to give you a more competitive ability to win that mortgage?
Yeah, I mean, all industries given, and you probably fight this in your own industry, Rory, is how do you keep from becoming a commodity, right? A utility where everyone's the same. And it's by differentiating yourself to actually help the consumer get what they want, which is a home at a price that they're comfortable paying, right? We're launching today at Annie Mac. I just was off a call before this one. We're calling it Just Don't Bid, Win, right? If our customers want their dream house, we got to give them every possible advantage to make that happen. So that's where we're coming from. On both of these products, we are not marking up the mortgage package, right? The interest rates, the cost of the loan itself are going to be 100% the same, whether they leverage a product like Cash to Keys or our Annie Mac appraisal waiver. We want them to have a great mortgage package. If they use Cash to Keys and we end up purchasing the home for them, the reason I say that is a lot of times our customers using our Cash to Keys, they end up buying directly from the seller. They get their home listed, they get it sold, they can line up closing dates. That product's free. It doesn't cost them anything. There is some costs that get involved if we end up purchasing a home for someone, but that's not profiting for us. It's really covering our cost of acquiring a home and reselling it to the customer. So again, it's reasonable when compared to the alternative, which is not getting your dream house and or having to make an even over asked bid to stand out because of contingencies. So again, it's designed to help the customer perform better.
Yeah, I'm happy to hear that. There's more value there because the industry is changing, and the traditional mortgage rates are still valid, or the traditional ways of financing are still there, but it is a much more competitive market. So it's interesting that you're going through that. Yeah. Well, this is great, Tom. Thank you for taking the time here. I think there's some big themes that I'll point out, and then you can kind of share or validate any of that. But number one is very competitive seller's market, and it looks like it's going to continue to be so. Number two, home prices have appreciated over the last 5-10 years and look like they're likely continuing to appreciate in value. Number three is the interest rates matter, but my takeaway is your why behind the purchase is more important, and your what was your little saying? You date
marry the house and date the rate.
Marry the house, date the rate. So purchase with purpose, essentially, and the interest rates might change. Hopefully they come down and you can alleviate some cash flow issues. But anything else to add for everyone listening before we sign up?
I think you're spot on, right? You go back 15 years, speculation was massive in our industry. Speculation's kind of out of it, right? We're not seeing a lot of speculative home buying. So it's either I need to buy a home or I want to buy a home because of my family situation, whether it's, again, first time upgrade or downgrade. There's still opportunities to invest, that can produce cash flow. Be smart when it comes to flipping, right? There's opportunities to flip, but really understand your numbers and cost structure to make it happen. And like you said, everything begins with why, right? Start with why. And that should be the foundation of any overall asset. Like I look at what I do as an extension of what you do. It's not just about the debt. It's about managing cash flow, managing the liquidity to make sure that you're not set up for a great home ownership experience, but you're setting yourself up for future growth.
Absolutely. And you got to know your numbers. How much you putting in? Are you making additional payments? Let's just evaluate what those numbers are and whether that's working for you from a net worth perspective, or whether you're ignoring that, which is rightfully so, because that's a big goal, is you don't want to have a mortgage payment. So there's no right or wrong answer, but I think you got to understand your own plan, and you also got to work those numbers. Super.
Perfect.
Awesome. Tom, thank you very much. Great discussion here on the state of real estate. Appreciate your time, and also great questions that helped keep our dialogue moving. So thanks everyone for tuning in. Tom, thank you. Have a great rest of the week. Yep.
All right, take
Bye.
care.